Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at EON Resources.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So imagine sitting on like 1.2 billion barrels of oil.
That is a staggering amount of wealth.
Right. Geologically, it's massive, just sitting right beneath your feet. But above ground, you were so completely strapped for cash that your auditors are literally flashing red warning lights.
Yeah, officially stating they aren't sure the business will even survive 12 months.
Exactly. That was the grim reality for EON Resources in 2024. They were just staring into the abyss.
It's the ultimate paradox, for resource-heavy companies.
Asset rich, but cash poor.
Right, to the point of bankruptcy. But what makes this deep dive so compelling is how they navigated out of that trap.
All right, let's move into the wealth building context.
Yeah.
Because if you're managing a portfolio, you have to establish exactly how a turnaround story fits in.
Yeah, this isn't a blue chip dividend play.
No, definitely not. And it's not a stock you day trade on a whim either. We're looking at a company that emerged from severe financial distress.
Shifting from a failing enterprise to, well, a deleveraged, well-capitalized producer in the Permian Basin.
And for wealth building, that shift is where the asymmetric upside lives.
Exactly. You're investing in the inflection point. The thesis here is capturing that massive multiplier effect when the market finally realizes, hey, this company isn't going to die.
Right.
But to understand the opportunity, you really have to appreciate the structural irony of their survival.
Vicious.
They didn't survive by acting like a traditional oil driller. They survived by acting like a ruthless, distressed asset manager.
I have to throw some caution at that, though. Like, I look at turnaround stories, and while the multiple expansion from near bankruptcy to profitability can be aggressive,
Oh, it's huge.
it demands a cast iron stomach. The road from distress to thriving is just plagued with early volatility.
Absolutely.
If you don't understand the mechanics of how they survive that crucible, the daily price swings will shake you out before the growth ever materializes.
Which is why we can't just look at their current state. We have to reverse engineer the financial plumbing that kept them alive.
Now let's look at the fundamentals, because the numbers from their unaudited 2025 financials tell a very counterintuitive story.
Yeah, let's start with the top line.
So unaudited 2025 revenue actually dropped to $17 million, down from $19.4 million in 2024.
And normally, if you're scanning financial screeners, a revenue drop is an immediate red flag.
Big time. But if you dig into the operations, their production held perfectly flat.
Right. They pumped 250,000 barrels of oil for the year.
Keeping production perfectly flat while under a going concern warning is practically an operational miracle.
Usually in distress, maintenance gets deferred, wells get shut in, and production drops off a cliff.
Because the company is literally starving for capital.
Exactly. But EON Resources managed to maintain the baseline. The drop in top-line revenue had absolutely nothing to do with operational efficiency.
It was entirely a macro issue. They suffered a $13 per barrel drop in average oil prices year over year.
They pulled the exact same volume of crude out of the ground, but the global market just paid them less for it.
But the big swing of this entire deep dive isn't the top line.
No, it's bottom line.
In 2024, they posted a $6.2 million loss. Fast forward to 2025, and they're reporting an unaudited net income of $15.7 million.
Which is a violent reversal into the green.
A huge reversal. Now, the context here is crucial. A massive chunk of that profitability, like $13.9 million of it, to be exact, is an accounting gain on an asset sale and debt forgiveness.
Right, stemming from a major recapitalization they executed in September 2025.
So it's not recurring oil revenue.
No, but forward 2026 EBITDA is projected at a very healthy $6 million.
Okay, I genuinely struggle with the math on this September recapitalization, so let's break it down. They secured $45 million through an overriding royalty interest, or ORII.
Yep, the ORI.
Basically, they took a lump sum of cash in exchange for giving a funder a fractional slice of their future oil revenue free of any drilling costs.
Exactly.
Then they used that $45 million to wipe out $68 million in senior debt, seller obligations, and preferred shares.
That's the distressed asset manager part.
But aren't they just trading one master for another? Like you eliminate a debt holder, but now you have a royalty partner skimming your top-line revenue forever.
It's a fair point.
How is that fundamentally better?
Well, it comes down to the mechanics of recourse versus non-recourse capital.
Okay, explain that.
Traditional debt is a structural noose. It demands fixed monthly interest payments regardless of what oil prices are doing.
Right.
In 2024, EON Resources was bleeding $8.7 million just in interest expenses alone. Yeah. If oil prices crashed, that debt payment was still due, pushing them toward default. And RRI is completely different. It's a non-recourse, equity-like burden.
So it scales with the reality of the market.
Precisely. If they pump less oil, or if the price of oil plummets, the RRI payout shrinks proportionally.
It never triggers a bankruptcy event.
Exactly. Plus, by using that $45 million to retire debt and wipe out $27 million in preferred shares, they permanently remove that $8.7 million fixed interest burden from their cash flow statement.
That's massive. And they also secured a $150 million common stock purchase agreement with White Line Capital,
which gives them a liquidity safety net they never had before.
It completely reframes their competitive moat, too.
Oh, yeah.
Because the asset base itself is unquestionable.
Oh, the geology is fantastic.
They hold roughly 20,000 acres across the Grayburg-Jackson and South Justis fields in the Permian Basin.
Sitting on 1.2 billion barrels of original oil in place.
And they've produced less than 7% of it.
The reason that 93% is still trapped underground is purely geology. The Permian is incredibly lucrative, but these specific legacy fields require highly capital-intensive horizontal drilling.
Specifically through the San Andres Formation.
Right. And as we just established, capital is the one thing they couldn't afford to waste.
Which makes the Virtus farmout agreement their ultimate masterstroke. Let me try to contextualize this farmout agreement.
Sure, go ahead.
It's like sitting on a massive, dilapidated, historic mansion. You know it could generate millions if it were renovated and split into luxury apartments, but you are completely broke.
Oh, I like that analogy. And instead of taking out a massive high-interest construction loan,
Which could bankrupt you if the renovation goes over budget.
you bring in a wealthy developer.
Right, that's Virtus.
Virtus absorbs 100% of the upfront financial risk to drill 92 horizontal wells. In exchange, Virtus earns a working interest in those specific wells.
And while EON gives up a percentage of the total upside on those new wells, it instantly unlocks 11 million probable net barrels for them.
Without a single cent of capital expenditure out of their own pocket.
For a company that was on the verge of death just a year prior, farming out the risk while keeping a slice of the reward is an incredibly elegant survival mechanism.
That brings us to the catalyst timeline. You can have the most elegant financial restructuring in the world, but the market needs actual operational sparks to start repricing the stock.
True. In the immediate term, the overarching catalyst is simply clearing administrative hurdles.
Right. They have an imminent fiscal year 2025 10K filing due.
We'll dive into the risks of that late filing shortly, but getting it published officially scrubs the uncertainty off the board.
And once the paperwork is filed, the entire focus shifts to the oil field this summer.
The operational timeline for June and July of 2026 is incredibly dense.
In June, they are slated to complete 5 vertical well recompletions.
Okay.
But the real needle mover is the arrival of the first 3 horizontal wells from that Virtus farmout.
Those are scheduled for completion in the June-July window, right?
Yeah, and they're projected to add 500 net barrels of oil per day.
We have to pause and look at what 500 net BOPD actually means mechanically for a company this size.
Let's see the math.
Their historical baseline is 250,000 barrels a year. If you divide that by 365 days, they were averaging roughly 685 barrels a day.
Right.
So adding 500 net barrels on top of that is essentially a 73% increase in daily production volume.
Funded entirely by their partner.
Wow.
And we have to look at the broader macro environment they're releasing this new oil into.
Yeah, we're seeing severe geopolitical tensions, specifically conflicts involving Iran and localized disruptions around the Strait of Hormuz.
When physical bottlenecks threaten the global supply chain, it puts a hard floor under crude prices worldwide.
Even though EON is pumping oil in Texas, a disruption 7,000 miles away restricts the global supply pool.
Making their domestic, politically secure Permian oil incredibly valuable.
It is the absolute perfect pricing environment for them to be bringing 73% more daily volume online.
Now let's pivot to the chart. If operations are hitting a massive inflection point this summer, the next logical step is figuring out whether the algorithmic traders and retail investors are actually pricing this reality in yet.
Looking at the price action, there is real structural resilience building.
Definitely. Following the April 28 earnings release, the stock traded up 2.59% in the pre-market, sitting at 0.808 tons.
From an analytical standpoint, it looks like a psychological bottoming process.
The market digested the historical trauma of the going concern warning, saw the newly scrubbed balance sheet, and buyers started stepping in to establish a floor.
When you zoom out and look at market structure, the long-term trend remains firmly intact. The stock is holding above its 200-day moving average.
For institutional quants, that 200-day line is the ultimate barometer of health. But what I find fascinating is the volume metric.
What's going on there?
Recently, the trading volume dropped to just 0.23 times the 20-day average.
So those tracking market mechanics, that abnormally low volume implies absolute selling exhaustion.
Exactly. Anyone who is going to panic sell during the 2024 distress or get shaken out by the recent broader market volatility has already liquidated their position.
The sellers are completely gone.
And low liquidity environments act like a powder keg. When the bid-ask spread widens because no one is willing to sell at these bottom barrel prices.
Any sudden influx of buying pressure eats through the available shares instantly.
It forces the price to gap up violently.
We've actually seen glimpses of that breakout potential already. There was a recent algorithmic spike that pushed the stock up 7.8% in a single session.
If the fundamental catalyst from the Virtus farmout pushed the stock past the psychological $1 resistance level, it changes the entire algorithmic landscape.
It forces short sellers to cover their positions by buying shares at a premium.
Which in turn triggers momentum scanners, bringing in retail volume. It creates a self-fulfilling momentum squeeze.
So what does market sentiment look like? Because if the technicals are tightly coiled and the fundamentals are turning, we have to gauge the underlying mood of the institutions holding the float.
If you rely purely on quantitative sentiment scanners, it looks muddy.
Yeah, the algorithms are pulling bearish headlines tied to the regulatory notice over their late 10K filing. Automated systems read late filing and immediately downgrade the sentiment score.
But if you bypass the algorithms and look at human analyst sentiment, the institutional mood is incredibly bullish.
The de-risking from the ORI recapitalization was a massive confidence booster.
And management just telegraphed an aggressive level of confidence with their 2026 hedging strategy, or rather, their lack of one.
Right, they're running a naked production strategy.
This strategy is fascinating. Let's look at how this mechanically works.
In the oil business, producers normally hedge their future output, right? They buy financial contracts that lock in a guaranteed sale price.
Let's say $75 a barrel.
It's an insurance policy. If global oil crashes to $50, they still get paid $75.
But if oil spikes to $100, they are capped at $75, and they miss out on the windfall.
And EON Resources has decided to leave their new 2026 production completely unhedged.
It is the corporate equivalent of canceling your fixed-rate mortgage and switching to a variable rate right before you expect interest rates to plummet.
You are exposing yourself entirely to the floating reality of the market.
It is incredibly aggressive.
But if those geopolitical tailwinds in the Strait of Hormuz keep oil prices elevated, EON captures every single penny of that upside on their new 500 barrels a day.
They don't lose a dime to hedging premiums or capped contracts.
It implies management deeply believes high oil prices are a permanent fixture for the foreseeable future.
The institutions are clearly noticing that confidence. Remember the $27 million in preferred stock they wiped out during the recapitalization?
Yeah, the preferred shares.
Preferred shares are often structured as toxic convertible debt. They act like a wet blanket on a stock's price because they represent massive institutional dilution pressure.
Just waiting to be converted into common shares and dumped on the open market.
Exactly. By eliminating that overhang entirely, they cleared the runway for institutional accumulation. And that brings us to the speculative undercurrents.
The rumor mill regarding the South Justis field.
Yes. Management explicitly noted they are actively sourcing volumetric funding and analyzing the horizontal drilling potential for their South Justis acreage.
And the industry rumor is that they're actively trying to replicate the exact same playbook they use with Virtus.
If they can secure a secondary farm-out agreement to monetize South Justis, that unlocks another massive reservoir of hidden value.
It would be a secondary parallel catalyst operating right alongside the Grayburg-Jackson wells.
Now let's talk about the risks, because ignoring the bear case in a structural turnaround is how you get blindsided.
And the bear case here is multi-layered. First, we have the administrative threat, delisting.
Right.
On April 22, 2026, EON received a formal notice from the NYSE for failing to satisfy listing standards due to the delayed 10K filing.
They have a 6-month compliance window to rectify this.
If they miss that window and get delisted to the OTC markets, institutional mandates will force funds to sell, liquidity will evaporate, and the stock will take a devastating hit.
It is a severe regulatory risk, absolutely. But you have to contextualize why the filing is late.
It isn't because of missing funds or operational fraud.
The delay is entirely tied to the brutal accounting complexity of executing that September recapitalization.
Valuing overriding royalty interests, calculating debt forgiveness, and retiring preferred shares takes an immense amount of auditor reconciliation.
And crucially, the raw financial data is already public via their recent 8K presentation.
So the market already knows the math.
Exactly. The 10K is just the formalized paperwork to clear the regulatory overhang.
Then there is the operational risk, which circles right back to that naked production strategy.
Their 2025 revenue decline proved this company's top line is hypersensitive to global oil prices.
Right. Their entire 2026 projected EBITDA of $6 million relies heavily on capturing elevated prices with unhedged crude.
If geopolitical tensions ease overnight, OPEC floods the market, and WTI crude prices collapse, that naked strategy backfires.
They have zero downside protection, and their margins will take a direct, disproportionate hit.
The commodity risk is real. A price drop would certainly compress their margins, but we have to look at how their resilience has evolved.
How so?
In 2024, because of their massive debt load, an oil price drop meant missing an interest payment and facing immediate default.
Right.
Today, with a delevered balance sheet and an ORI structure that scales down with revenue, an oil drop just means they make less money.
They won't go bankrupt.
They are structurally engineered to survive the downside now, which completely changes the risk profile.
So with everything on the table, what's the final verdict?
Synthesizing the financial turnaround, the catalyst timeline, and the macro environment, the underlying research issues a bullish score of 7 out of 10.
That's pretty solid.
You have a company that successfully pivoted from a distressed, debt-burdened operator to a well-capitalized producer with a scrubbed balance sheet.
They have 92 horizontal wells being carried by a partner, perfectly timed to add unhedged production into a structurally tight global oil market.
The setup provides massive asymmetric upside.
And how should investors view the target horizon?
This is firmly a multi-year hold. The true valuation unlock isn't going to happen in a week.
It requires patience as the San Andres horizontal drilling program scales up.
And compound production growth is realized through the second half of 2026. This is a structural growth story, not a quick momentum flip.
Just to leave you with one final thought to mull over, we spent a lot of time today dissecting how a company found salvation in mature, heavily drilled assets like the Permian Basin.
Yeah, it's fascinating.
It forces you to look at the broader market and wonder, as billions of dollars blindly chase the next shiny, unproven tech trend, how much massive generational wealth is just sitting dormant in legacy industries, waiting for the right financial architecture to come along and finally unlock it.
That's a really great perspective.
Need emergency cash? MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.